All right, today we are diving deep into a really tricky, high-stakes corner of Pennsylvania tax law. We're talking about how the state taxes intellectual property. Now, if you're a creator in Pennsylvania, maybe an author, a software developer, an inventor, this is not just some boring accounting detail. It can be an absolute financial minefield.
And honestly, it all boils down to this one simple-sounding question. Because in Pennsylvania, the answer to this question literally changes everything about what you can deduct, what you end up owing, and how the state views you as a taxpayer. And believe me, getting it wrong can be incredibly expensive.
Okay, so here's our game plan. First, we're going to break down Pennsylvania's truly unique tax system. Then we'll get into the main event, the clash between royalty and business income. After that, we'll look at the key legal test auditors use, walk through what an audit actually looks like, uncover a really nasty state versus local tax paradox, and then wrap up with some solid, concrete defense strategies you can use. Let's get into it.
So, to really get what's going on here, you have to understand that Pennsylvania's personal income tax system operates in its own little universe. It's completely decoupled from the federal system you're probably used to. For instance, you know how on your federal return you might use a loss from a side hustle to lower your taxable income from your day job? Well, in Pennsylvania, nope. Absolutely forbidden, and that one rule is where all the trouble really starts.
This slide really lays it all out. On the left, you've got the federal model. You make $100,000 in wages, you lose $20,000 in a side business, you pay tax on $80,000. Pretty straightforward, right? But now look at Pennsylvania on the right. Income is locked into 8 separate boxes or classes. So that same $100,000 in wages, you're taxed on the whole thing. That $20,000 business loss is stuck in its own box, completely stranded. It gives you zero tax benefit. This isn't just a policy, it was cemented in a court case, Marshall versus Commonwealth, and it's the engine that drives this entire audit strategy.
And that brings us right to the 2 key income classes that are at the heart of every single intellectual property audit. Where your income lands here has massive financial consequences, all because they have wildly different rules for what you're allowed to deduct.
First up, we have Class 4, which is royalty income. You can think of this as the default bucket for what the state considers passive income, things like patents and copyrights. But the really critical thing to see here is that deduction standard. Expenses are only allowed if they are for the production or collection of the income. And let me tell you, auditors interpret this as narrowly as humanly possible. We're talking things like your agent's commission, and that's about it.
Okay, now let's look at the other side of the coin. Class 2, net profits. This is for income you get from actively operating a business. For any IP holder, this is where you want to be. Why? Because it unlocks a much broader range of deductions. We're talking marketing, travel, R&D, your home office, all the actual expenses it takes to run a modern creative or tech business.
And this table right here, this is the whole story in black and white. This gets to the financial heart of the entire dispute. That home office that's essential for you as a developer, it's allowed as a business expense, but flat out denied as a royalty expense. What about the R&D for your next big idea? Allowed for a business, denied for a royalty. You can see right here why the Department of Revenue is so incredibly motivated to push your income into that royalty box. It lets them deny nearly every single one of your real-world operational costs.
So, the big question is, how do auditors, and eventually courts, decide which of these 2 boxes you belong in? Well, they use a legal doctrine called the commercial enterprise test. This is the legal battleground where these fights are won or lost.
And the entire framework for this test comes from a single 1992 case, Wettach versus Commonwealth. Now, in that case, you had a partnership that just owned one office building and leased it out to their own law firm. The court basically said, hey, that's not a real business. You're just passively holding an asset and collecting rent. The Department of Revenue grabbed that ruling and ran with it, applying it directly to intellectual property. They argued that if you're just licensing your IP to, say, a single publisher, you're not running a business. You're just holding an asset, same as that landlord.
So, the court's reasoning has been boiled down into 2 simple questions that auditors now ask of everyone. First, are you really out there actively participating in the market and offering your services to the public? And second, are you providing significant ongoing services, or are you just kicking back and collecting a check?
Let's make this real. Here's how this plays out for an author. An auditor looks at an author who has a contract with a single publisher. The auditor's argument goes like this. The publisher is your only tenant. You, the author, aren't selling books to the public every day. Your publisher is doing that.
So their conclusion? The author is just passively holding a copyright, exactly like the landlord in the Wettach case, and the result is a swift reclassification to Class 4 royalty, and poof, all those deductions for research trips and home offices are gone.
Okay, so we've got the legal theory down. Now let's look at the practical mechanics. A Pennsylvania royalty audit is almost never a random event. It's a very predictable process, a playbook really, with clear triggers that you can actually anticipate.
The whole thing almost always kicks off with an automated flag. You have to picture this. The Department of Revenue's computer systems are specifically programmed to hunt for certain data patterns that suggest a taxpayer might be misclassifying their IP income. It's not a person, it's an algorithm that flags you. So, what are these digital red flags? Well, reporting a loss on Schedule E is a huge one. From their perspective, if your deductions are truly limited to just the cost of collection, how could you possibly have a loss? Another big one is a mismatch in your 1099s. If you get a 1099 MISC, which suggests royalties, but then you report that income as a business on Schedule C, that's going to get their attention fast. And of course, high-risk expenses, like a big home office deduction, or even just listing your business as licensing, can put you on the list.
Once you're flagged, the auditor follows a very clear playbook. Step 1, they apply that Wettach test to argue you're not a real business. Step 2, they move your gross income from your business schedule over to the royalty schedule. Now this right here is the killer move. It leaves all your legitimate business expenses stranded back on Schedule C with no income to offset, which creates a completely useless loss. Then they apply that super strict collection standard to the royalty income, disallow pretty much everything, and generate a nice big tax bill.
And the result of that whole maneuver? You now owe tax at Pennsylvania's flat rate of 3.07%. But here's the kicker. It's on your gross royalty income, before any of your real-world expenses are taken out. And of course, that's before they add on the penalties and interest.
But hold on, because the danger doesn't stop with the state. We are now entering what is easily the most treacherous and, frankly, counterintuitive part of this entire system, the conflict between state and local tax law.
This slide just perfectly illustrates the insanity of this paradox. The state argues your income is passive, Class 4 royalty, for the specific purpose of denying your business deductions. But at the exact same time, local tax law, under a rule called Act 32, says that because you created the IP yourself, the income is considered active net profits, which means it's subject to the local earned income tax. It is a classic heads I win, tails you lose setup, and the taxpayer's always the one who loses.
And this is not just some theoretical problem. The private companies that collect local taxes, like Keystone and Berkheimer, they get the state tax data. Their computer systems see that royalty income, and if it looks like it came from self-created IP, boom, they automatically send you a bill for local tax. And then the burden is entirely on you to prove that they're wrong.
Okay, so after all that, how in the world do you fight back against this incredibly complex system? Let's talk about some key proactive strategies you can use to build a really strong, defensible case from day one.
Look, the best defense here is truly a good offense. First, document absolutely everything. Keep detailed time logs of all the work you do, the coding, the marketing, the customer support, the R&D. This is your hard evidence to fight back against that passive argument. Second, keep a separate business bank account. Never ever mix your business and personal funds. It just makes you look like a hobbyist. Third, if you do get that dreaded audit notice, your very first response has to frame the narrative. You must immediately assert that you are engaged in an active trade or business, not some passive investment. And finally, if you have any sway with your clients, push them to issue you a 1099 NEC for non-employee compensation. It's a document that screams business, unlike the 1099 MISC, which just whispers royalty.
So in the end, it all comes back to this one fundamental question. In the eyes of Pennsylvania tax law, is your intellectual property just a static asset that you own, like a piece of furniture, or is it the direct product of your ongoing daily activity? As we've seen, the financial difference between those two simple words is absolutely everything.